The numbers for the second quarter look to have come in much better than expected. Some of that is, of course, because your impairment charge is much lower than you'd been anticipating, so expecting fewer loans to turn bad, I suppose. So that's all very good. But what kind of message, because you're sticking to overall guidance, so what kind of message about your performance does this communicate to the markets?
Well, morning and thanks for having me. We've announced a robust set of financial results today, very much in line with guidance and consensus. This is a really important year for us. We're in the middle of our 5-year strategy and the results for Q2 are robust. I think the second message, which is good, is we're seeing growth in the business in line with our growth and innovation strategy. We saw 5 billion of new savings deposits come into the bank in Q2, over 4 billion of new lending, and we've seen growth in market share in a number of areas. So that's really important. And that's given us the confidence to reconfirm both 24 and 26 guidance, but also increase our interim dividend 15%. So good news for our shareholders.
OK, and just a bit more on those provisions and the fact that you haven't had to take provisions to the extent that the market had expected, Charlie. Does this tell us a very positive picture about the UK consumer, about mortgage markets, the UK economy? What positive message do we take from that?
Yeah, so we've said actually for a while now, we see the economy as very resilient, and we're seeing our customers as really weathering the challenging last few years, but really this year is showing more resilience. And it's across the piece. We're seeing improvements in resilience of our mortgage customers, our consumer borrowing. Businesses are performing really strongly and better than our expectations this year. And then businesses as well across the UK. So there is good resilience in our customer base. It's slightly beaten our expectations. We did also have some releases within those numbers, but underlying performance is good. And business confidence remains strong in the UK. Now, we are still only guiding to less than 1% GDP growth this year. So we start from a resilient place, but we're not yet seeing kind of the investment and the change in the trajectory of the UK economy. And that's one of the things we're very focused on.
Well, Charlie, I hear you were hanging out in the number 10 Downing Street garden recently with the new Prime Minister. Over time, then, do you think that he can hit his 2.5% growth target? And how long will it take to get there?
Well, I think the starting point is we welcome the new government's focus and their primary mission focus around economic growth and development of the UK more broadly. We agree that that's the way to unlock the improvement for all of our communities across the UK over the coming years is getting growth going again. And then the focus of this new government on really looking at some of the supply side changes that need to be made. You know, planning is a great example, or looking at connectivity in the grid and starting to look at housing differently. And so those are the priorities we have, is really working in partnership with the government to make those things happen. At the moment, our baseline forecast for the economy, as I said, is about 0.8% in GDP growth this year. And at the moment, growing up to about 1.4, 1.67% in 25 and 26. And that isn't meeting that 2.5% growth target. But we do think leaning into some of these opportunities for unlocking growth and then getting investment going, there is an opportunity to increase the pace of growth in the UK economy.
Well, on that, do you take Keir Starmer at his word when he says that there isn't going to be a windfall tax on banks, or are you planning for it just in case?
Oh, look, that's a decision for the politicians, and obviously you've heard the statements from the government so far, and that'll be a political decision going forward. No, that's not our focus. Our focus is really, as you know, we're the largest financial service group supporting the UK economy by a long way. And our purpose of helping Britain prosper is very aligned with supporting the economic growth and the improvements in the economy across all sectors, whether it's individuals, households, businesses, or international corporates trying to invest in the UK. That's our focus. And it seems at this stage well aligned with the new government.
Well, just going back to mortgages, we've seen the 2-year gilt yield at a 1-year low this morning. Bets on Bank of England rate cuts picking up. We've got a decision next week, of course. Your peers have been cutting mortgage rates in recent weeks. I think HSBC's cut mortgage rates 3 times in a month. When can we expect the same from Lloyds Banking Group?
Well, actually, we've been the same. We're very dynamic, and we have a 5-year mortgage at around the 4% range, which I think is, as in the rest of the competition in the market, is up at the top of the market in terms of pricing. The key thing, I think, around mortgages, as you know, customers are choosing still to lock in a mortgage rate for 2 or 5 years. And that's meant that this year we've had rates around that 4% available for customers, even though the base rate's at 5.25%. So we're protecting customers today. Obviously, as we look forward, we are predicting in our guidance to say that base rates will probably over the next couple of years only trend down to about 3.5%. And we will be pricing off the forward-looking curve. So we do think there'll be stability unless there's a change in expectations around mortgages and mortgage pricing. It's a very competitive market. And as you know, we're the leader in that market, and we really gained some good share of flow in Q2. So we're very comfortable with the services we're providing to customers and our ability to compete.
Charlie, I want to build on that story of kind of the local economy as well. We know that Lloyds has announced plans to shutter some of the branches across the country as well. We also know that the FCA, from a regulatory standpoint, is trying to push for more branches and more of that local banking story. How do you square the two? Are you going to be reviewing that policy?
Well, I mean, the starting point is we've got by far the biggest branch network in the UK today. We have over 1,000 branches supporting our customers in communities right across the whole of the United Kingdom. And that's a great place for us because it means that supports our position around serving everyday banking needs and our small businesses. The second part that's important on branches is, of course, we'll be led by our customers. And customers have been really shifting their behavior. In the last 2.5 years, 3 years, since I've been in this role, we've seen a growth of 30% of digital customers, people logging on at least 30 times a month, and the capabilities available to them digitally have gone up. And in that same period, we've seen a reduction in our branches, the same branches at a community level, of up to or more than 30%. So there's a real shift in customer behavior, and our strategy and our focus is to be customer-led in that context. Yes, the FCA came out with some new guidance around access to cash yesterday. The good news for us, I need to go through the details over the next few weeks with our regulator, but it looks very aligned with the way we take decisions at a local community level and make sure there is availability of other services if we make a decision to close a community branch. So that looks very aligned with our current processes. The key thing, though, here is we're the biggest digital service in the UK, we're the biggest branch-based banking provider in the UK, and we know that that's really important for many of our customers, and we'll continue to evolve that as our customers' behavior changes over the coming years.
So, Charlie, let's then go from that domestic story to the international one. We know, of course, in this new government, and Lizzie kind of hit on this as well, there is a big push to bringing in that international investment. In your view, what's getting in the way of that?
It's different for different sectors. I mean, the starting point, and I guess you'll have seen this through your conversations in the last few months, is actually the UK has been an area over the last few years which hasn't been a priority for many international investors. But in the last 6 months and in the first 6 months of this year, we've seen real interest in the UK, including in my own sector, including in financial services. People looking to the future and seeing that the UK looks like a stable place and a place they want to invest over the coming years. The next thing then is where people are investing. And as you know, we're the biggest supporter of some of the biggest international investors into key areas like the energy sector, like infrastructure, like housing, which is where people really want to invest. And the issues are different by sector, but they come down to things like planning reform, connectivity to the grid, clarity around the government and society's commitments to some of the key technologies, and then in some sectors, some areas, really making sure we're using the brilliant universities and apprenticeship schemes in the UK to build skills for the future. International investors want to see those things being unblocked, and our core belief is, and we're a big facilitator of international investors into the UK, our big belief is if we get clarity around our priorities and we unblock some of those things, we're going to see real interest in investing further over the coming years in the UK.
Some of those investors, Charlie, might come from private markets, from private equity, private debt. What plans do you have to muscle in on that $1.7 trillion private credit industry? We've recently been reporting that Oaktree Capital Management is partnering with Lloyds on one project. I don't know if you can tell us about that, but what broad plans do you have in the sector?
Yes, I think when you think about long-term investment, patient capital, there's a few different sources, and we've already been a leader in all of those in the UK. But just think about it through. Obviously, bank-based lending is really important. Syndicated debt and making the bond markets work remains a really important part of financing those areas. As you know, we have a really significant insurance company and a pensions business, and that's one of the areas where we can invest ourselves through our insurance business, our Scottish Widows business, and partner with other insurance companies. Legal & General is a leader in this context in the UK that we partner with in this context as well. And then, yes, sponsors and private credit is another important area of investment, and we're a leader in supporting those providers and enabling customers to get access to that finance across the piece. And of course, finally, equity, whether it's IPOs, but our own equity business. We have a Lloyds Development Capital business, which is investing in businesses across the UK at a community level. So all of those forms of investment are important. Private credit brings another form of long-term patient capital, and whether it's international private credit markets or private credit businesses emerging in Europe and the UK, we do think there's real opportunity to bring that money to bear, and we're partnering with them. And Oaktree is a really good example of us doing just that.